Let's take a few minutes to do a quick review of current liabilities. So those are going to be obligations that we have to pay within the upcoming year. And there are a few different current liabilities that we've discussed before. Notes payable, again, formal written promise to pay, usually with interest and a due date attached. Accounts payable, those are liabilities we have with our suppliers. So we go out and purchase product, they're going to send us a bill. Unearned revenues, don't forget, this isn't a revenue, this is a liability. It's unearned, meaning we haven't yet earned it. So we have an obligation. We received money up front. Now we have to provide a service or deliver a product. Examples would be gift cards you buy at retailers, you get a deposit in advance for service that you have yet to provide. Until you provide that service, this is a liability. And then other types of accrued liabilities. So those are liabilities we've incurred but not yet paid. So let's start off talking about notes payable here. Again, it's a formal promissory note, usually has interest attached to that. And it's important to make the distinction here between current and long-term liability. So if it's due within the current year, it's going to be current. And this is very important for companies and even people because we need to know what obligations or what debt we have coming due rather soon, so we make sure that we have enough money to pay those obligations as they come due. So we've covered notes receivable, so this is just the flip side of that. Here's an example. On August 1st, 2004, Matrix Inc. asked Carter to accept a 90-day 12% note to replace its existing $5,000 accounts payable to Carter. So in this particular company, Matrix maybe doesn't have the money to pay Carter right away, but maybe they have a big job coming in 60 or 90 days, and they think at that time they'll be able to pay. So they ask Carter to say, hey, wait a minute, I can't pay you right now, but if you give me 90 days, I'll pay you the full amount plus interest, and that's what they're doing. So we're just going to debit the accounts payable. That has the impact of removing that liability for $5,000. And we're going to replace it with a notes payable, hence the credit here to notes payable for $5,000. That increases that liability to now notes payable. And then we should know how to calculate the interest based on when we did notes receivable not too long ago. We're going to take the principal amount, which is $5,000, times the annual rate, 12%, times the length of time. So this is 90 over 360. And remember, 360 is the banker's rule. It's not 365 days in a year. We use 360. So that means the interest that was incurred on this particular note is $150. So when they actually go to pay that, they're not going to pay the $5,000 that they borrowed. They're going to pay $51.50, which is the principal plus interest. So we'll credit cash for $51.50. We're going to debit the note payable for $5,000. That has the effect of removing that from our books. Because we debit it, we're reducing it. And then we debit interest expense for $150. Debits equal credits. We look good there. Here's another example of a note. This time we went to the bank and we just got a $100,000 loan. We debit cash because in exchange for signing that contract that you promised to pay that money back, they're going to give you a check. So we debit cash, credit notes payable for $100,000. This says that First National Bank agrees to lend $100,000 on March 1st, 2002. If Cole Williams Company signs a $100,000 12% 4-month note, we debit cash, credit, accounts payable. Okay. And then let's calculate the interest on that particular note. It's a 4-month note. Face value, $100,000 times the annual interest rate times the length of time. So 4 months out of 12 means my interest will be $4,000. Debit interest expense for $4,000, credit interest payable. And the only reason we're doing this is because it looks like they're preparing their financial statements on June 30th when we're not actually going to pay off the note until the following day, which is July 1st. So we want to record the expense that's been incurred on that note to make our financial statements more accurate. This will actually reduce the amount of net income we have. And we'll credit interest payable because we have a liability to pay that. So then on the next day, instead of crediting the payable, we will debit payable $4,000. That removes that liability. Debit notes payable for $100,000, and we credit cash for $104,000. Again, Principal plus interest gives us the cash credit of $104,000.